Now, meanwhile, the land grab for Facebook shares continues. GSV Capital Corp just bought 225,000 shares of Facebook at a $70 billion valuation. Here with us on Bloomberg West is Michael Moe, chairman and CEO of GSV Asset Management, who says Facebook is a one-of-a-kind business. So, Michael, Facebook now accounts for 15% of your portfolio. How did you buy so many shares at that price?
Well, we worked really hard. We have multiple sources that we went to before our offering. We've been involved in the private marketplace for some time, so we had a pretty strong view of companies that we'd have an interest in when we had the offering done, and Facebook was at the top of that list.
Now, you bought this at a price of a $70 billion valuation, and you consider that a discount?
Well, if you look at where the shares are trading, that was at $29.28 a share. If you look at where Facebook shares are trading currently on the secondary market, it's pretty consistently $33 to $35 a share. So, any way you look at it that way, we feel that that's compelling. And then just our math says that at $70 billion or $29 a share, we feel like the upside is sufficient to warrant a large position for us.
Now, I want to turn this over to Cory Johnson, our editor-at-large. We've been looking a lot at valuations of private companies. Cory?
Yeah, what gives you the confidence that this thing's going to be worth more money? What do you know about Facebook that leads you to think it's going to be worth more than what you paid for it today?
Well, first of all, we've created analysis based on what we think the ups are for the business model. So this year we expect Facebook to do north of $4 billion of revenue, have operating profits of nearly $2 billion, with lots of ups to that.
So you see a 50% operating profit on this business?
45 is what we believe.
Come on.
It's a media business with tremendous leverage, and they're just starting to monetize its different opportunities.
Among the interesting questions that raises are the companies, the ancillary companies on top of Facebook, like Zynga, which are thought to have revenues about half that size already.
Right. So, I think what Facebook has done in a very strategic, kind of relentless fashion is to create real network effects with true engagement with its 750 million users. And so the ability to monetize that, whether it's through, obviously the easy channels are advertising, or through the applications and the toll that they extract, or from their Facebook currency. I mean, there's the different levels of monetization has just begun. It's really the first inning of that.
All right, well, let's talk about some of this, because Facebook has been very busy hiring, very busy building lots of private servers. We learned a little bit about that, strangely, in the Fusion IO filing, where we see that they're buying solid-state disk drives to build their own servers. They're spending tons of money. You think even after all that money, they're not spending a couple billion more than that a year?
It's a phenomenal business. And so I think, the whole point of what we're doing with GSV Capital is to create a publicly traded access vehicle to invest in the leading private companies in the world. And Facebook, it basically prints money.
So how do you manage that in terms of achieving a result from that investment? Usually that means selling. Right? When my wife always wants to buy something for the house, I say, it's not an investment unless we're going to sell it. We're not selling it. Are you going to sell these shares sometime?
Well, we clearly bought them to own them as long as we think the growth characteristics of Facebook are what we think they'll be. But if we were paid a price that represented the kind of return we're looking for, we'd sell them. And the good news is, for what the vehicle represents, is we can either do that through the secondary market, or we can wait for an IPO. Either case, we think we have the option for the shareholder.
And Michael, your stock, GSV stock, is up more than 40% today on news of this deal. Quite a spike there. I'm curious, how difficult was this deal to get into compared to other deals that you've done?
Well, it's not easy to acquire shares of great companies at attractive prices, so we had to work it very hard. But we had a clear perspective on that we wanted to own Facebook shares. We knew multiple sources to go to, and we worked those sources very, very hard. So that's one of the reasons why we think having a professional fund to create a portfolio of leading private companies is attractive, because we are in the marketplace every day, and we are working hard to not only buy shares of great private companies, but also at a price that makes sense and give investors a publicly traded liquid security.
Quickly, would you say it's the hardest deal you've ever done?
Well, we just started the fund 6 weeks ago, so it probably ranks up there because we haven't done many, but we worked very hard at it, and we're excited about it.
So you explained why Facebook. Did you look at other hot quote-unquote private tech companies out there like Twitter, Groupon, Zynga?
So what we've been doing over the past couple of years, and I'm a founder on the board of SharesPost, and we've been very active at evaluating different private companies. Effectively, we created an NFL draft ranking from number 1 through 100 top private companies. And so one list is, who are the best companies in terms of fundamentals and growth potential without looking at the valuation. The second piece is, what price can you acquire shares at, and can you get enough shares? And so
where does Groupon, for example, a very controversial company, where does that rank on your list?
Yeah, I think Groupon is controversial. I think the filing that they had recently exposed some things that I thought were flags. The concept of earnings before expenses, is a little bit unusual, and that to me says it's a type of situation. Obviously, the growth is phenomenal. There's a number of people from the investor side. You have Axel, you have Kleiner Perkins, you have Andreessen Horowitz. That's a great sign. But there's a number of pieces to the Groupon story that I think represent caution. And so we're not quite as optimistic about Groupon as maybe some other high-profile names.
And Cory, you definitely have thoughts on this. You've been pouring through the S1 filing.
I've spent a little bit of time looking at the S1 filing. We spent a little bit of time talking about it when I saw you last week. When you look at the Groupon deal, as you say, one of the things you see is scale. And you see these, not to dump on Groupon, you see a business that's gotten really big with really big losses. Is that the sign, I'll ask you the bubble question, is that a sign that companies that are not profitable, that are losing tons of money, is that a sign that we're in a bubble again?
Well, we'll see if the market, how it responds to it. I think Pandora is an example of a company that I think is an interesting product, but it's losing money, and clearly it was a Roman candle, at least in terms of its early days of public business. Groupon, a lot of heat around Groupon right now because of the growth and everything else. Again, I think there's a number of things that could give investors pause.
So I guess what's different? Last bubble, you were at Montgomery Securities for a while there. That was a company that was an IPO machine here in San Francisco. Brought a lot of great companies public. Bought a lot of other companies public. What would be a sign to you that we're in a bubble?
Well, in the bubble days, you were taking basically a business plan public, with a bunch of hopes and dreams. In Groupon, in fairness to Groupon, they've gone from a business plan 2.5 years ago to a business that's on pace to do 2.5 to 3 billion of revenue this year, with huge losses and all sorts of other issues. But those, you were having businesses that truly were ridiculous or had no proof of concept that were able to get out at healthy valuations. If they didn't trade up 100%, people thought something was wrong. That was a bubble. I think even you just look at the activity of stocks right now, there's a lot of caution. I think you have to be a real business to be received in the public marketplace. And I think all this, to me, says that we're fine.
All right, Michael Moe of GSV Asset Management, thanks so much for joining us. I was reading a post yesterday about why it's so hard to predict bubbles, and you only necessarily know in the retelling of history, not when you're in the middle of it. We'll have to leave it there. Thank you so much, Michael Moe.